Instruments of world financial markets. The main advantage of the Forex market from the point of view of ordinary trader is the relatively small amount of initial investment. For trading on Forex, it is enough to have a small amount of free money and internet access. In Forex market, currencies and currency ratios are traded. Initially, the trading is implemented in the interbank market. Stock trading is carried out on stock exchanges and is another popular form of trading in financial markets besides Forex. Since stocks are simple, basic instruments, trading them is relatively easy. If a trader expects growth, he buys. If decline, he borrows shares from brokers and sells them. For the convenience of trading general trends in stock market, numerous stock indices were invented. The price of such index is the price of a certain subset of stocks averaged by various rules. Indices are traded on stock exchanges along with common stocks. The idea of combining securities into separate generalized tools belonged to Charles Dow, the founder of Dow Jones Index, which combines stock prices of 30 largest U.S. companies. Indices can reflect the dynamics of both the entire market and individual sectors. Of course, financial trading is not limited only to currencies, stocks, and indices. This is, for example, such a concept as the derivative markets, whose role is mainly in trading in futures and options. These derivatives are traded on exchanges. Futures are basically a contract for the sale of underlying asset given a point in time in the future at a set price. This tool is a margin, and therefore, together with the prospect of greater profits, the risks of large losses increase significantly. Another example of financial instruments are options. Unlike futures, options give the right but not the obligation to buy or sell an asset at a fixed price in the future. In addition, options are not tied directly to currencies, stocks, and indices, but as a rule to futures on them. Options are divided into two types: a call option that gives the right to buy an asset at a fixed price, and a put option, on the contrary, giving the right to sell the asset. Options are more difficult to understand because they are non-linear in the nature. In 1973, economists Fisher Black and Myron Scholes created a new financial model that determines the theoretical price of options, and is called the Black-Scholes formula. This formula was the reason for the popularity of these tools. The advantages of options are concluded in the controlling risks and the possibilities of implementing high-yield transactions at relatively low costs.